Welcome to the deep dive. Today we're unpacking the UBS Global Real Estate Bubble Index for 2025, our mission, to give you the key insights on housing risk and reality worldwide. And the big thing right off the top, the paradox, is pretty striking.
Yeah.
Global housing markets have actually cooled for the third year straight, which suggests maybe less immediate risk. But, and this is the kicker, affordability. It's worsened by about 30% globally since just 2021.
Yeah, that's right. And it's crucial to see the backdrop for this. I mean, we're looking at this index while global public debt is pushing towards 100% of GDP.
Wow.
Which really leaves governments with, three pretty tough choices over the next decade or so.
Not great options, I'm guessing.
Definitely not. We're talking painful austerity, potentially high inflation, or something called financial repression.
Okay, hold on. Financial repression, can you quickly break that down for listeners? What does that actually look like, and how does property benefit?
Sure. So essentially, it's when the government deliberately keeps borrowing costs low, often actually below the real rate of inflation.
Right.
And the surprising thing the report highlights is that real estate, well, it kind of stands to benefit whichever path is chosen. It acts like a financial shelter.
How so?
Well, think about it. Under high inflation, any fixed-rate mortgage debt you have gets eroded in real terms.
Okay, makes sense.
And under financial repression, with interest rates kept artificially low, hard assets like property become one of the few places you might actually find a positive real return.
Got it. So property as a shelter in this difficult macro environment, if that's pushing people towards real estate, where's the actual, speculative bubble risk highest right now, according to the index?
Yeah, the immediate risk seems most concentrated in North America and Asia, actually. The index flags Miami, Tokyo, and Zurich right at the top of the bubble risk charts.
Miami again.
Miami again. Still number one, most overvalued globally. Prices there have just soared, up nearly 50% in only 5 years.
50%. That's incredible. But, okay, this brings up a really interesting point about the traditional big players. The report shows a huge shift.
A major shift, yeah.
London, Paris, New York, historically pretty risky markets, they're now rated low risk. I mean, low risk. That feels like a massive change from just a few years ago.
It is a massive change, and it raises that key question. Is this a genuine, healthy market correction? Or is it just, a temporary dip caused by the interest rate shock that hasn't fully played out?
The uncertainty.
Exactly. I mean, the data shows London's real prices, adjusted for inflation, are actually 20% below their peak back in 2016. That's a significant drop.
20% below peak. Okay, so where is the heat then?
Well, the market's really heating up now seem to be cities like Dubai and Madrid. They saw the biggest jumps in their bubble scores. Dubai's actually back to its 2014 peak levels, partly fueled by population growth.
And this cooling in the big established centers like London and New York, presumably that's tied back to fundamentals, not just sentiment.
Precisely. It's linked to fundamentals. You see, price-to-rent ratios have actually dropped.
Okay, how did that happen?
It's because rents have been rising quite strongly, up around 10% in those high-risk cities over 5 years. But incomes, they've only gone up about 5%.
So rent growth is outpacing income growth.
Exactly. So the affordability problem isn't gone. It's just maybe less driven by pure speculative buying right now.
You mentioned that 30% drop in global affordability earlier. How does the report really illustrate that pain for, an ordinary person trying to buy?
They use a great metric, actually. It's the number of years a skilled service worker would need to work just to buy a fairly modest 60-square-meter flat near the city center.
And the numbers are?
They're pretty staggering. It's 14 years in Hong Kong.
14.
12 years in London. Even in Miami, which you might think has more space, it's still 5 years of that person's entire income.
Wow. And it's not just the sticker price, is it? The worsened affordability driver is really the cost of borrowing?
Absolutely. The high interest rates we've seen have basically doubled the monthly cost of owning a home, even if the actual listed price hasn't moved much or even cooled slightly.
Doubled the monthly cost.
Yeah. And look at Zurich and Munich. The report flags them as having the world's highest price-to-rent ratios. We're talking over 40 years worth of rental income tied up in the price of a home there.
40 years! That's the definition of speculative excess, right?
That's certainly how we measure it in these markets, yes.
We also saw, during the pandemic especially, this big shift in demand away from city centers, didn't we?
We did. Most major cities actually underperformed their wider national housing markets for a bit. You had that trend of hybrid work pushing people towards the suburbs looking for more space.
Is that likely to stick?
Well, maybe not entirely. UBS expects central banks will probably start cutting interest rates, but gradually, maybe through 2026.
Okay.
And that should help stabilize housing demand, potentially supporting it again. The bottom line is, in this world with so much debt and complexity, property still functions as a necessary financial shelter for many.
Okay, so if we pull all this together, the debt, the shifting rates, the global changes, what's the main takeaway for you, for the listener?
I think the biggest takeaway is this. The era of easy, almost guaranteed gains fueled by cheap debt, that's definitively over.
Right.
Future returns in real estate are going to depend much more heavily on, the basics, local fundamentals.
Which brings us to that final thought, maybe something provocative for people to consider.
Yeah, the report concludes that future stability and returns really hinge on jobs, wages, and critically smart urban planning. So the thought to leave you with is this. Consider those cities that were high risk but are now rated low risk, like London.
Okay.
Which of those cities might actually be best positioned for a recovery driven by fundamentals if, and it's a big if, they can finally tackle their strict planning restrictions and allow housing supply to actually catch up with population demand?
Ah, so the structural supply issue, that's the long game.
That's the real long-term challenge and opportunity, absolutely.